Hey, what's up, everybody? October 8th, Tuesday. So, this afternoon, we were close to a recovery in the market. And I said that was going to happen today. And then, a recovery for the day. And then Powell came out towards the end of the day and said that the Fed was going to restart, or actually the way he phrased it is that they were going to engage in permanent operations of supplying liquidity or asset purchases, 15 billion per month starting in November. Now he went out of his way to say, hey, this is not QE, but it is QE. Let's face it, it's a mini QE. So the market turned tail and really went down sharply after that announcement, which is interesting because actually that's the correct reaction. But it's kind of funny because for so many years we've been hearing so many people, everybody really saying, oh, QE, that's money printing, that's pumping up, that's inflating everything, that's pumping up the asset markets. And of course, I've always explained that it is actually not the case whatsoever. It's actually negative. So we did have the proper reaction in the market. And let's understand something, and I think it should be clear from the videos I've been making recently that the turbulence in the market and the weakness now that we are going through is a function of monetary policy. Bad monetary policy, bad management of monetary policy, if I could say that. If you want to go back, in August, the Fed took reserves down too low, basically put the whole entire system short. All right, you had 13 trillion of deposits in the banking system. They brought it down to 1.3 trillion, so you were right at a threshold, that 10% reserve ratio. Some banks, probably the smaller or the mid-size and the smaller banks were getting squeezed. You had the overnight lending rate go way up above the Fed's target rate. They had to step in, they started doing these repos, and then they came in big with these repos and the 14-day term repos, and I said that was going to send the market down. And it's exactly what happened. And I've been bearish short-term based on these monetary operations, which came about as a result of the Fed not knowing basically what it was doing and just continuing to guide reserves down blindly, not paying attention to where deposits were in the system, and then overreacting and causing all this to happen. Now they're saying, okay, now we're going to do this permanently starting in November. And again, he went out of his way to say this is not QE. We are doing this, he said, to stabilize our overnight lending rate, our policy rate. So 15 billion a month. Now, I haven't worked through the numbers yet. I'm going to kind of do another one of these back of the envelope calculations. 15 billion a month. Don't forget, you get net reserve drain every month from treasury sales. So this might not be that bad, all right? But I have to say we first have to get through this month when there is going to be probably a significant increase in reserves, and that is what is causing the market to go down at this point. But moving forward, when we get to November forward, when this goes into effect, and again, I got to work the numbers up, but my sense is that 15 billion a month, we can handle that. We can handle that. Now this market pullback, again, created by the monetary operations that are going on right now, this dumping of reserves, this market retrenchment, probably will present a great buying opportunity sometime in November. But we have to let this play out, and I want to work through the numbers. I'm not 100% sure. It seems like 15 billion a month and a stable policy rate, it seems like this is not going to be such a big deal. But let me work through the numbers. Again, this is going to go out to my subscribers. If you want to get on board with this information, if you want to understand it, then please go to my website, pitbulleconomics.com, and sign up for a 30-day free trial of MMT Trader. All right? Talk to you guys later. Bye-bye.